Welcome to Edison Atlantic's first Capital Chasm vodcast. 3 weeks ago, we released a report about the risk of a potential capital chasm emerging for small and mid-cap companies, a deep gap between the demand for capital and its potential supply. This has caused some lively debate. The idea of a capital chasm seems absurd given what we're currently seeing in the markets, with small and mid-caps in particular performing well on both sides of the Atlantic. However, if it does play out, given the significance of smaller companies to both employment and as a key driver of economic growth, it stands to potentially rupture both the UK and US economy. We think this is an important issue, and I'm delighted today to be joined by a panel of leading UK market experts who can offer their perspective. First, Richard Penny, a multi-award-winning fund manager from Crux Asset Management with 28 years of small and mid-cap investing experience specializing in technology and life sciences. Second, Chris Mayo, head of primary markets Americas for the London Stock Exchange Group. We're delighted to have Stephanie Baxter, a senior and experienced journalist with an impressive CV, including The Telegraph. And last but not least, our very own Neil Shah, Edison's managing director of content and strategy and lead author of the Capital Chasm report. Neil, let's start with you. So the markets have held up extraordinarily well during the pandemic, and yet you predict there could be a capital chasm. Could you outline the main thesis of the report, please?
Sure, Rachel. I mean, my passion around small and mid-cap companies really came from the last financial crisis, where they were the net contributors to job growth and a recovery in terms of contribution to GDP when a lot of the larger companies were dropping jobs. And my concern was, well, were these companies going to be able to shore up their balance sheets and secure enough capital to overcome some of the challenges and the transformations that we're going to see in the markets going forward. Now, the report starts off by tracking, what's happened in the markets over the first 3 months. And you're right, what you've seen, and the big difference, I think, between this financial crisis or this crisis and the last financial crisis is that the markets were willing to support. Yeah, you've seen a lot of follow-on activity in the US market. You've seen a lot of IPO activity and companies coming to market. But this pandemic is going to last some time, and the real debate here is: is the level of support that we've got coming out of institutions, coming out of government, sufficient to overcome the length of the pandemic? And that's the debate we're going on to. The concern is that currently, any kind of exogenous risk, any delay to the vaccine, means that there probably is going to be a gap. And so there's been some leading lights on the institutional side who've also flagged this. Anne Richards at Fidelity, the CEO of Schroders, they've all talked about the need for companies to reach out to a broader pool of capital to raise the amount of money. I think that we've only just started the process. There's much further to go. I think that over the next 18 months, we're going to see a real continuation of that demand. That's against a backdrop where public equity markets over the last 10 years have really been facing a decline in companies coming to market. And one of the debates here is: are we going to see a sea change? Are we going to see more companies actually coming to access public equity? The numbers that within the report highlight that the amount of capital raised within Europe is 50% down from an IPO perspective compared to a decade ago. Similar kind of numbers in the US as well. So there is a genuine risk. It is a risk that companies aren't going to be able to sufficiently fund themselves to ride out what is ahead of us and potentially to take advantage of the opportunities ahead of us. And the report concludes by making some recommendations in terms of policy responses. And it's been encouraging that since the report's come out, actually you've seen some of those policy responses being enacted, including, Rishi Sunak continuing or looking at extending the furlough scheme in a different guise. So I'm encouraged by what we're seeing on the ground today.
Great, thank you, Neil. Right, so I'd love to hear from each of our panelists now in turn, whether you agree or disagree with some of Neil's comments. So perhaps Stephanie, if you could go first.
So what I thought was really interesting in the report is looking at the different funding challenges for small to mid-sized companies. I think it's really important to look at the potential sources of equity capital from institutional investors particularly, such as pension funds. The thing is, pension funds used to take up about 60% of new UK equity issuance. But as the report notes, that's now fallen to about 20%. And this is really because pension funds have been moving away from equities over the past sort of decade or so, to moving more to bonds so they can better match their pension liabilities. But at the same time, those pension funds are also looking to diversify their existing equity allocations. And interestingly enough, they've actually been investing more in small to mid cap companies in recent years. I think there's one statistic that says European pension funds increased their investments in small to mid caps from 12% in 2009 to 22% this year. And also, it's really important to look at a more kind of diverse investor base. So not just UK, European pension funds, but also US pension funds. A lot of those will be looking to diversify their equity allocation to different regions. So they may well be interested in looking at UK small to mid caps. The Canadian pension plan is looking at investing in small to mid caps, actually. It made a big announcement following COVID-19 and said that's where it sees a lot of growth, and is quite interested in digital and healthcare companies. I actually spoke to a large UK pension fund the other day, who said to me, it's what they really like when in investing in small to mid caps is they can have a much bigger impact on those companies, and it can end up being a much more collaborative arrangement than when you invest in a very large company.
Great, thank you, Stephanie. I'm delighted to hear you say that companies need to be on the front foot of their IR strategy and targeting diverse pools of capital. We very much echo that at Edison. Richard, perhaps you could give us your opinion.
Yeah, I think pre-COVID, I think we've seen the continuation of a trend that goes back 25 years in the UK. The long-term institutions, so the pension funds and the life insurance companies, have gone down from 40% of the UK market down to 8%. And, you know, colleague comments and commentary I had with peers in the marketplace, I mean, roughly a year ago, I would say that the bottom 2% of the market was really a market where most of the mainstream investors had exited, and it was down to tax specialists, the BCTs, the EIS funds, high net worth individuals, less so, but a few of the wealth managers are still in that area, but they had to some extent exited because of regulation. And I think the principal reason why we've seen an increased exit in recent times has been because of liquidity of open-ended investment and savings products, whereby if you cannot sell what you bought in the morning in the afternoon, the compliance department will tell you you're not allowed to own it. So it had become a much decreased participation in the market, certainly under a couple of £100 million. And that was particularly badly felt for growth companies that need to raise money sort of every 18 months, 2 years to grow their businesses. They were finding it very, very difficult to raise money at valuations, anything like the value of the money they'd put into them or the true worth that they had in the public marketplaces.
Great, thank you, Richard. And I'm sure, Chris, you'll have an opinion on that. If we can move to you next, please.
Yeah, thanks, Rachel. You know, clearly, as we've heard from the other panelists, there are still challenges, and that's really what the report outlines. But what I would say is it's heartening to see that smaller companies in the UK have been able to raise capital in both the main market and AIM during the crisis, and that we actually saw more capital raising in the first half of 2020 than we did in the first half of 2019. I think there's also a striking difference in the breadth of the market for sub $1 billion market cap companies when we talk about capital raising between the US and the UK. When you look at the US, the report outlines that capital raising for companies below that $1 billion threshold has been dominated by biotechs and SPACs, whereas in the UK there has been a broad base of support across many, many different sectors. So when companies needed the capital, the smaller micro-cap companies needed capital in the UK, the money was there for them during this crisis. I think that's what I would take away from this. There's a train of thought in the US that you shouldn't be a public company if you're below $1 billion of market cap. That's kind of a rule of thumb that's come through. What I would say is in the UK, we've proven during this crisis that's certainly not the case. There is a lot of value to being a smaller microcap company because you can access equity on an accelerated basis, literally within 24 hours, out overnight. And what I would also say is that, you know, this isn't in the report, but since we've come back from the summer break here in the Northern Hemisphere, the UK IPO market has shown that it's alive. We've seen the IPO for THG, which is $2.4 billion, largest e-commerce IPO in Europe ever, which was listed in London. But we've also seen microcap IPOs for the likes of Coop, and we actually have a couple more that have announced in the last week. So the IPO market is there. Capital appears to be there for companies of all shapes and sizes.
Fantastic, thank you. So that's the report as it was written 3 weeks ago. But now I'd like to request each of our panelists in turn to outline a new perspective for consideration. So Stephanie, perhaps if you could begin.
Yeah, sure. So environmental, social and governance issues are increasingly important for institutional investors to take into account when they make investments. And it's really become even more particularly important in the past sort of 12 months or so. And that's being driven by a lot of regulatory requirements on pension funds, such as disclosing climate change risks and things like that. So I think this is really one way that that companies that are seeking to raise capital from investors that they could work on. So ESG risk can mean different things to different investors. And the most obvious one is climate change. So making sure that companies are prepared for a lower carbon economy, but also looking at things like gender diversity, having diversity on your board, making a social impact in your community. But I think what's interesting is that the biggest fund manager in the world, BlackRock, earlier this year sort of hit the headlines when it announced that it was overhauling its investment strategies and engagement with companies to take account of ESG risks. And it's going to become even more so important. The UK pension fund that I mentioned earlier said to me as well that they are increasingly holding companies that they invest into account on ESG risks. They tend to invest quite a bit in small to mid caps, and while they appreciate that smaller companies will have less resource than larger companies to look at things like corporate governance, they kind of really just want those companies to work more on those ESG factors. And also mentioned that the corporate governance code for small to mid caps could be an interesting one to look at. I just think working on your ESG policies and doing a bit of homework can help you stand out above the rest.
Thank you, Stephanie. And ESG has certainly been a hot issue in investor relations in 2020. But is this a passing fad or phase, or do you view it as essential that smaller companies need to adopt ESG practices so they don't fall into this capital chasm?
Yeah, I mean, ESG isn't going to go anywhere. It's the momentum is just going to keep on increasing, and it used to be considered just to be an ethical thing. And pension funds did not take it seriously enough. But now these risks are considered to be financially material, and the idea is that one day that we won't even use the term, the acronym ESG, that it will just get embedded into the process when investors are investing and the financial risks that they take into account.
Excellent, Chris. I know that you've got some questions or thoughts to maybe add. For Stephanie?
Yeah, I thought what Stephanie said was fascinating, and I should probably give you the plug out the way to start with. LSE, the London Stock Exchange Group, were just named Sustainable Stock Exchange of the Year by Environmental Finance magazine. I think part of the reason behind that is that we've developed a whole set of products to help both investors and also issuers understand the kind of ESG factors that are driving their business. So LSEG, London Stock Exchange Group, owns FTSE Russell, and FTSE Russell is an index provider which runs lots of ESG focused indices. But I think what has changed over the last few years, I think there's been a fundamental change. I think Stephanie has hit upon this. If you looked a few years ago, what you would see is you'd see negative screens were kind of the order of the day. It'd be, I'm going to invest in everything apart from fossil fuels. And there'd be indices that track that. Now what we're seeing is that for every single company, there's a complex model of both environmental. It used to be environmental was the order of the day, but now social and governance kind of issues have become just as important. It may be diversity, it may be anti-corruption. And people like, organizations like FTSE Russell have got very complex models which have, on a very granular basis, enable any investor, so it doesn't have to be an ESG focused investor, to be able to rank where this company fits from an ESG perspective. So what I think is what's changed, it's become from a niche product to becoming a mainstream consideration for all investors, but also all issuers. And what I would also say is from an LSE perspective, what we've done is we've produced guidelines for issuers in terms of, on a sector by sector basis, what we think are the most important things for them to be reporting on. And this stuff will become absolutely standard. It used to be environmentally focused. It used to be focused on fossil fuels. It used to be focused on large caps. Now it will be small caps in all industries will have to produce information, so investors will be able to benchmark these companies across various ESG factors. And I think that's where the environment, pardon the pun, has fundamentally changed from an ESG perspective.
Thank you. Stephanie, would you agree or disagree with Chris? You don't need to say anything. I think we've got a lot there, but just interested.
Yeah, no, I couldn't agree more. That's really great, the work that LSE has been doing. And yeah, I think this is something that that all companies are just going to have to do more on. And I think we need to just not look at it as ESG. And the amount of stories that I write about ESG, it's probably daily sometimes, and it's great. But it is about, this is the future. And I think anyone out there that doesn't think that these are important risks is not really seeing the bigger picture. So yeah, it's really, really important.
Could I ask you, Stephanie, in terms of, is this something that the pace of which you've seen ESG sort of being mentioned within the community that you talk to, i.e. the pension community, how fast has that changed over the last say 12 months?
It's changed. It's changed so much, phenomenally. It's ESG is something that never really used to be taken seriously enough. So I used to write about this a few years ago, and investors would just pay it lip service. But yes, especially the last 12 months, it really has gained a lot of momentum. And a lot of that's been driven by new regulatory requirements on investors like pension funds. But also earlier this year, the world's largest investment manager, BlackRock, overhauled its investment strategy to take account of ESG risks, bringing climate change into that. So that was seen as quite a big moment. But certainly, now when investors like pension funds and invest in companies, they are definitely looking for those companies to show that they have good corporate governance, taking into account ESG risks. So just basically been asking them a lot more questions than they were before.
Yeah, I mean, I've seen that the mandatory reporting requirements are all about to change for the asset management community. New Zealand first to introduce it, but EU, UK soon behind. So when we're thinking about sources of capital, I'm guessing that it's going to be really important for companies to actually address the ESG compliance effectively to get access to that capital.
Yeah, I think it's really important. And actually, a big UK pension fund that I spoke to just recently was talking about this. So they currently have investments in small to mid caps, and they are already looking now, checking if those companies are abiding by the ESG principles that the pension fund has in place. So asking them a lot more questions. Now the pension fund said to me, well, we do understand it's much more difficult for smaller companies to have the resources to implement things on corporate governance. But they said, look, we as a big pension fund have resources to help companies do that as well, which I thought was really interesting. But basically, companies, it's not just about climate change. It's about having good corporate oversight, having a board which is independent and can challenge. And one of the things that has been mentioned to me, which small companies should do, is try to abide by the principles of the QCA's corporate governance code for small to mid-cap companies, and have a look at that and see what you can do.
Great, thank you, Stephanie. And Richard, I'd be interested in your perspective here as an institutional manager as well.
Yeah, I mean, it is important in the institutional market rather than the more retail savings market. It is very important for the pension funds that are going that way. It's a pragmatic point as a fund manager that if you were investing in oil stocks, you have to be aware that a lot of these guys are selling out. So you may well invest in something that's cheap, but you may not get the uplift there. From my point of view, just the way that we invest, I'd prefer to see the directors of a company investing in the shares and buying it and putting their own money there, even if the corporate governance code was not exactly to the letter of some of what the big companies do. But for a smaller company, if they're buying shares at the same price that I'm buying them, for me that's more important. But for the large organisations, they do have these sort of blanket themes. But from an ESG point of view, there will also be a lot of growth from that, just in terms of investing in some of those markets. So things like renewables, energy storage, decarbonisation of transport. And, you know, if you buy those small companies early, and if the particular businesses in question are exposed to that, if you can buy a small company, those are far more likely to get money, because there are a lot of specifically ESG funds, which frankly have got a lot of money and trying to find a place to put it.
Yeah, exactly. And to that point, I did see a UK small cap broker published quite a comprehensive report last week on ESG, and there were listed over 150 funds, I would say, that all had ESG mandates. So it definitely looks like it's
yeah. I would say from a retail savings point of view, people that buy those kind of ESG funds, you are buying into that ESG vision, and you may well help decarbonisation. But if there's too many of these funds around and they're all investing in the same things, perhaps early in the life cycle of some of these technologies, they may well lose quite a lot of money, which is what happened with some of the internet funds in 2000. So sometimes when there's a big theme and all the money's going after it, they inflate the prices. There aren't enough investments. There's a very attractive run in some of those funds early, but it can all end in tears sometimes.
An excellent point. Okay, great. Well, moving on. So to Chris Mayo at the London Stock Exchange Group. Chris, what new topic would you like to bring to the table today?
So I'd like to talk briefly about the issue of IPO pricing, which has become a very controversial topic, especially within the US. And I think, again, it highlights that there are actually a lot more differences between the US and UK capital markets than people think. So this is commonly referred to as IPO pop in the US. And really all it means is the difference between the IPO price and where the company trades at on the first day. So just to give you some really kind of eye-watering stats, I think, since the start of 2017, there have been 190 IPOs in the US that have popped more than 25% on day one. And there have been 73 that have popped more than 50%. So the company went up more than 50% from its IPO price. So 73 for that particular stat. Now, if we look at the equivalent stats for the UK, the equivalent numbers for 25% are 16 companies that have done that. And for more than 50% increase, the equivalent stat is 0. So 0 companies in the UK have gone up more than 50% on day one. Now, what I can point to as the key differences here are there are really different kind of structural aspects when it comes to the UK IPO process, which improve price discovery. So you're allowed to do much more extensive testing in the waters in the UK than you are in the US. You're still allowed to do deal research in the UK, which allows you to do better price range setting. So most deals price within the price range if they price in the UK, and that's not the case for the US. And also we typically have larger free floats again, so we have less restricted supply of stock into the market. And really those are things that are distinguishing between the UK and the US in that regard. Now, one of the things that's kind of been a an outgrowth of this in the US is people are saying the IPO process is broken there, and we're seeing a lot of SPACs as a result. So when you look at IPO issuance this year, it's been dominated by SPACs in the US. About 100 SPACs have gone public, raising about $40 billion. It's dominated the IPO market. And I think what's important to understand is in the report, that will be classified as a small cap issuance. It really isn't, because most of these deals will, when it actually comes to their acquisitions, will be probably 5 times as large. So a $400 million SPAC range may end up in a $2 billion acquisition. You'll have a $2 billion company that's public. So really, this is not a solution to small cap capital raising. It's really something that's probably in the mid to large cap arena in lots of cases. I think it's kind of eye-watering to think that $40 billion is probably $200 billion worth of public companies, which is a lot. And I think we also need to realize that that capital is going to go a lot of places. So there will be IPO pipelines in the UK and Europe that will essentially be cannibalized because of this SPAC activity.
Great. Thank you, Chris. And you obviously, working for the London Stock Exchange Group, have a UK perspective, but both you and I work interchangeably between the UK and US markets. And even though you're seeing more retail participation in the UK market, there's much higher degrees of participation of retail in the US market. So to your point on IPO pricing and on day one of trading, is this not just retail exuberance and something that's been going on through COVID in terms of, propping up the trading, being amplified on day one of trading, being amplified then again by trading algorithms? And is this a phenomenon likely to go away once once that level of retail participation normalizes?
I would say no, because the stats I quoted are from 2017, but I think that is one aspect of it. So I agree with you there, Rachel, in that a lot of what people aren't always comparing apples and oranges. So they may say, you've been able to price your deal at $20 for, $1 billion of stock. Clearly, the first trades that happen are not for $1 billion of stock. So even if it starts at $40, that is not equivalent for a clearing price for $1 billion of stock. So I think we don't compare the right things there. But there is a clear argument that these IPOs, there is not as much transparency and visibility about where the pricing should be. I think it is interesting in the UK, you just do not get this phenomenon. But I would say is you are correct. We've seen much more retail participation in both the US and in the UK, but I think it's particularly in the US. And in the US, a lot of people are chasing hot IPOs. I think is a phenomenon we're seeing in the US, which we probably aren't seeing in the UK. I think also it's important to say, if you have more free flow and you have more supply, you have less constraint and less of a kind of a squeeze driving the price up. But I think also the point that we've made with regards to IPOs in the US is a lot of people think the true price tends to happen once you've had the lockup expiry after 6 months and you have insiders selling out. Now in the UK, it's actually more common at the point of IPO to have incumbent shareholders to sell. So again, that's something else that increases supply. So there is a supply and demand issue at play here.
Chris, I just wanted to ask you on the growth of SPACs. How much concern? I'm not based in the US. I'm just curious as to how much concern there is about the level of due diligence of, the vehicles that are then sort of reversed into the SPACs, and what investors are seeing versus a traditional IPO process where, there is verification. There's a lot more detail in that sort of process. Is that something that you're seeing being raised?
On SPACs specifically, it's funny you should say that. Actually, the chair of the SEC, Jay Clayton, came out today and said he was going to scrutinize the disclosure around SPAC acquisitions more because it is, not as stringent as actually what you'd see in an IPO registration statement. And so I think where the SEC is hinting they're going to look is actually have a lot more disclosure required around the acquisitions. Obviously, in the US, shareholders get the ability to vote on that acquisition to decide if they want it to go forward. But I think there is a view that perhaps the disclosure on SPACs has not been to the level it would be for an IPO, and they want to level that kind of playing field. So the SEC is definitely focused on that area specifically, and they came out and said so today. So that may kind of, dampen the enthusiasm perhaps for some of the SPAC sponsors to go forward. But let's see. Also, given the amount of money that's out there, there'll be essentially a ticking clock to get these deals done. There'll be a scramble to do deals, and obviously in that scramble, there may be some deals that are suboptimal. So we'll have to actually see. I think at the moment there are 138 SPACs looking for acquisitions. So just consider that. So that's 138 potential new public companies.
Yeah.
Thank you, Chris. And again, Richard, I'd be interested in your perspective on Chris's comments, both on IPO pricing, contrasting the UK process versus the US, as much as you want to comment there, and also whether you as an institutional manager, what your opinion is on SPACs.
Yeah, SPACs, I mean, generally speaking, the UK hasn't been that buoyant in terms of getting money in sort of post-Brexit. It's a bit of an unloved area of the global markets. And a lot of the stocks are very cheap, particularly in the smaller micro caps. So for that reason, any manager with any money wanted to dedicate it there. There are refinancings and there's companies that are running out of money that people are getting involved with. And that's kind of the normal cycle. In sort of technology and healthcare, I'd say the companies in the UK are often hugely cheaper than they are in the US. These kind of valuations of Snowflake at 14 billion with 100% EBITDA loss margins it's just not the kind of thing we see in the UK. The UK is a far more conservative market. And to that extent, we have seen a lot less IPOs. And I think for the people that see and review these deals, where they get the cash, they are putting it into some of the bargains that are out there, which are very, very attractively priced and actually to some extent have been going up this year. And quite often there's always been this case that in Europe and the UK, like-for-like businesses are usually trading, can be at 10 or 20% of the value of some of the US comparators, which to be fair are often more mature businesses addressing bigger marketplaces. But I think the root of that is the fact that you've had the venture capital backdrop, you've had Amazon and Apple, and a lot of people have invested in these companies and made a lot of money. And if they're taking profits because these become huge parts of their portfolios, then they're going to invest it in similar types of businesses and they're going to have that expertise. And they're very used to very inflated valuations. So you sell something that's very expensive and buy something that's slightly less expensive, that's kind of okay. But it's not okay for us, and we've got quite a lot of cheap, interesting businesses.
I think that's a great point, Richard. And certainly within life sciences and technology, we're seeing a lot of US investor activity into the UK market, into UK companies currently, just given the attractive valuations. Great. So Richard, this is a perfect segue. So perhaps you could now offer your perspective, your new topic for discussion. Yeah,
well, I mean, a year ago, I was speculating with colleagues that the market in small caps has been as bad as it has for some time in terms of companies trading at really low, attractive valuations for an active manager. But, when are we going to get the uplift? So with COVID-19, you would logically conclude it's got even worse. Actually, far from it. The market is as good as it has been for some time. And looking around and working out why that is, quite a few reasons. But I think people have saved money. The millennials, the 25 to 34-year-olds, have been opening up ISAs and SIPs. There is more people sort of day trading from home. And I think with the leg down that we saw in COVID-19 in global markets, quite a few of the shares where perhaps institutions had been selling because of Brexit and their move up above 500 million, some of those overhanging lines of stock were taken out by retail investors coming into the marketplace. The people that are investing, we're investing in ETFs. I've been investing in Amazon, Apple, Tesla. Their initial foray into these markets, they were made an awful lot of money in those. And of course, they'll tell their friends about that. If they sell and take profits, they'll have profits. And we've seen them also going into the more intuitive stocks. So certainly media-driven stocks, COVID-19 stocks, there's 10 or 15 stocks in the UK, many of which are up sort of between 3 and sort of 10, 15 times. And, again, people would put money into those. They would have further profits to take. Gold mining's been popular. The move from kind of more immediate COVID-19 stocks has come down into the sort of biotechnology names. I think oil is traditionally quite a popular stock for private investors, but I think that's been a lot more difficult for obvious reasons. Sort of green themed stocks, sort of some of the decarbonisation names, they have been popular as well. And so it's been more buoyant, and more money has been raised at higher levels, and there is more liquidity. Now, liquidity is interesting because institutions that maybe want to sell would be able to sell, and then that money is then available to invest in other names and provide new capital for these companies. And I think the companies that have really benefited from this are probably the knowledge-intensive companies that need a few more pounds. And those COVID-19 stocks, if they were trading, let's say, at a pound level pre-COVID-19, they might have gone down to 50p, but many of them have bounced to sort of £2 or £3 now relative to the pound, and they would be raising money at 1.50 or £2, a discount to the screen price. They would then raise money from the institutions, who would then sell them back to the retail fund managers again, and they've stayed pretty buoyant.
Great, thank you. And Richard, your UK Special Situations Fund at Crux has returned 38% in the last 6 months, which I think versus the FTSE All-Share was about 16% in the same period. So, so congratulations to you. That was the last 6 months. As you look forward to the next 6, 12, 18 months, how are you thinking about your investment strategy?
Yeah, so more of the same. I mean, the reason why we've done well is because we were investing on a 2 to 3 year time horizon, and some of these sort of life sciences and technology businesses that are very, very cheap, you have to invest on a 2 to 3 year time horizon because, in smaller, less liquid businesses, you don't know quite when you're going to get the uplift or how it's happened. In some cases, it happened very quickly because of the boom that we've had. But these share prices, sometimes overhanging lines of stock get removed, a stock at a time. So we have sold some of them and taken profits in names. And, there are hundreds of names out there, and it's a sort of systematic undervaluation that happened because of Brexit and the liquidity crisis. There are plenty of other places to reinvest that money. And apart from those, I do invest in mid and large cap companies. Actually, some of the sort of large cyclicals and indeed financial companies are very undervalued, because we, 10 out of the last 12 years, we've seen growth outperform value, and we've seen a lot of very large growth companies get to levels where they're eye-wateringly expensive, so you wouldn't invest in them. So that's why I invest in small growth companies. And then some of the large value stocks, it's not very fashionable, but they look incredibly cheap.
We alluded to it previously, which is the Woodford effect. Firstly, the change in regulations, or the focus on stock liquidity has changed as a result of that. Do you think that part of the sort of participation in retail has been that retail are doing it for themselves on the back of the Woodford effect?
I think some of the people that are opening new accounts probably do gravitate to the Apples and the Amazons, those kind of names, just names they know about, the sort of kind of Peter Lynch way of investing. But actually, once they do that, they'll discover that there's pretty good stuff on social media. There's whole networks of things you can see. There's really good access to the company websites. So in terms of what companies can do, making the PowerPoints available on the investor section of the website is pretty important. And that's actually important for me as well, because if I want to do some desk work before I meet a company, I want to see that kind of stuff. And if it's not there, I might be move on to the next one, or I'll have to ring up the brokers. It might escape my attention to do that. So I think people, it's a lot easier to do that. And there's quite a lot of, as I say, social media sites. And there's a lot more thriving sort of network of people doing that. And it certainly helps when people start to make money. The rising prices create profits, and the profits go into more, and that creates more profits. And actually, to move the market sort of 5 or 10%, you don't need 10% more of the stock market value to go in. If you've got 1 or 2% of the value of a company going in, but all of them are buyers, you can move the price quite a lot quite quickly. And we are starting from a low levels where the directors are buying shares. So for those retail investors buying, often they're buying things that are very attractively priced with the directors. not sure whether I quite answered your question there, but.
Well, I think it was kind of. I mean, I think retail is participating. They're participating, doing their own work, and I suspect that rather than I was just wondering whether there was ever any kind of feeling of having seen all the stories around Woodford, they thought that actually I'm gonna do this for myself rather than to invest via a manager.
I would imagine anybody who has opened up a SIP or an ISA and is invested straight into Tesla and Apple and Amazon would think that they're far better than most of the professional fund managers out there on the basis of 3 stocks over 3 months. It doesn't quite work like that, but good luck to them.
On retail, obviously, we've seen, looking at anecdotal evidence, we've seen an increase in activity, a significant increase in activity in the UK and the US. They've also seen that. In the US, as Richard alludes to, there's been a lot of things about Tesla and Apple, a lot of leveraged kind of exposure to those kind of opportunities, be it leveraged ETFs or call options. You've seen a lot of that in the US. But in the UK, we've just seen just a regular increase in the amount of retail trading has increased probably above 20% of the total from being kind of lower teens in the start of the crisis. So I think that's important. But what I would say, and also I'd say LSE has a partnership with Primary Bid, which is a place where you can actually offer capital raises and even IPOs to retail. And they've done a lot more deals this year than they've done in the previous 3 years. So they've seen a significant increase in the amount of activity. And it's really been from micro caps up to companies the size of Compass, which have used Primary Bid. But what I would say is, increasing retail participation is something that we all want, but let's face it, it's not going to fill the gap. And so if institutional exposures are falling, then you're going to need to look at different pools of capital. You're going to need to look at different geographies, be it Europe, be it the US, if you really want to succeed and actually be almost mitigate the risk of not having enough pools of capital. You're going to have to look way beyond the traditional sources. And really, that's probably the point of this report.
I guess I wanted to kind of build on what the guy said, actually. So, retail investors, I know a lot of my friends have gotten into investing for the first time. They've got money on their hands and they've really enjoyed it. But that's not going to fill the gap. But I think one area that could fill the capital gap in the future is with defined contribution pension funds, which now all companies have to legally provide. So when I was talking earlier about what pension funds are thinking, I was talking about defined benefit pension funds, which are sort of dying out. But defined contribution pension funds, the government is consulting at the moment on trying to get defined contribution pension funds to invest in more illiquid assets and things like venture capital. And I'm really hoping that it will become easier for those pension funds to invest in small to mid-cap companies in the future. At the moment, it's difficult because they are restricted. But hopefully it will become, a couple of years' time, it will become a lot easier. And that's where the biggest growth is being seen. Actually in most companies.
Thank you.
I think that would drive more investment into venture capital. I think the boom in venture capital in the US came from liberalization of pension rules in 1979. I don't get out very much, so that's how I know that. And when people invest in these things and all the pension money comes in, then companies can get readily funded at all stages, particularly in the growth phase when they need frequent capital. And that's, obviously the US are very good and have a very well developed VC industry, but they've done that and then they've got the success stories. Amazon grows and then son of Amazon is born as some of the management leave and they set up their own, and that culture is there. And then all the financing people that do that, and they have the track record, which encourages people to invest with them. I think that's all been very positive. But I think that would go to venture capital, and I think one of the reasons why less companies are on the quoted market is because the venture capital market, actually in Europe and to some definitely in the US, is more buoyant. The valuations are higher. From an investment point of view, actually, you're probably better off in the public markets, particularly the small cap markets where things are cheaper, But in terms of finding the capital, that is a problem for companies on quoted markets.
But I mean, my retort to that would be, I agree with the point, by the way. I think the abundance of private capital, especially in the US, has driven a reduction in IPOs materially, and also regulation around IPOs in the US has done that too. But I would say is one thing, and it goes to the point I made at the start, one of the things I would say about this crisis is it has shown the value of being a smaller public company, because if you want to raise, you know, $50 or $100 million and you're a private company, even with abundant VC, that's hard to do, because that's going to be structured. That's going to take negotiation. In the public markets, we've had companies that have been able to do that during the crisis, literally within 24 hours. And that really shows the value of being a public company, even as a $150 million market cap company, as an example.
Totally agree with you, Chris. And actually, one of the things that I think is going to be interesting is whether you see, as a result of COVID-19, the sort of the sea change of, you know, the last decade was the VC private equity funding companies. And, you know, one of the things I've been hearing is that companies do want to access public markets. They want access to that sort of sources of capital, and, you know, they are bringing forward you know, their IPOs from, you know, 2021 to today. And I just wonder whether, you know, you're going to see, you know, private equity VC actually, you know, wanting to rebuild their liquidity, bringing companies back onto the market, but perhaps at you know, slightly more sort of sensible valuations than have historically been the case.
Yeah, so you can't necessarily give them another uplift. If they're at too high a level with their sort of preferred equity and all this kind of thing. If I can buy stuff that's a lot cheaper elsewhere, if I can do a rescue refinancing, I don't want VC stuff that's 3 times the price.
Yeah, I agree. Yeah, no one's going to, people, you know, at the end of the day, certainly from an institutional and actually from, you know, most sources of capital, they will look on a comparative valuation and say, does this make sense? You're not going to buy something you don't think is going, certainly, you know, and you're probably not going to have a job very long if you did, where you say this valuation is completely out of whack with the market. So I think that's actually, when you look at the US, that's quite interesting. You know, obviously you've seen IPOs recently that have popped a lot, but I'll leave you one last stat. So there's been 12 IPOs in the US that have popped more than 100%, you know, this year. Only 25% of them are still trading above their IPO price. So think about that.
Yeah.
So the valuation settled down is really my point, even after pops.
And then moving finally to Neil, in closing, Neil, so what new perspective would you like to bring to the discussion?
I think I mean, there's a lot of factors we've talked about, but I wanted to put one number out there because I think it's hugely significant in terms of the roadmap forward. So Fitch put out an estimate of $7.6 trillion is the amount of fiscal intervention or stimulus that you've seen in developed markets for the pandemic in the current year, and that's equivalent to 11% of 2019 GDP. So it gives you an idea around the quantum. And I think that coupled with the QE that you've seen, so, you know, the US amount of money being put in by the central bank is equivalent of 20% of GDP in the US, 9% in the UK, Canada, 7% in Europe. The level of intervention that you've seen is huge, is significant. And when I was observing the markets, it really lit up the market. You know, as you saw COVID impact, you know, what was the very first thing companies did? Well, they shored up their liquidity, and the ones that were able to do that were, you know, the largest blue chip companies with rated paper. They were drawing on their credit lines, issuing bonds into the market. But as the intervention came in place, you saw the high yield market starting to light up, and then the equities market starting to light up. So underpinning, I think, the buoyancy of the market, the support, the capital that's been flowing, has been this support that has been coming from government and policymakers. And I think it's hugely important that there remains a focus in terms of what else they can do if the pandemic continues. And that is, I think, where I think a lot of the debate is going to be going forward, which is how long do we keep supporting this for? So far, I've been really pleased that you know, you have started to see governments you know, roll forward initiatives in perhaps a slightly different way. I think that as long as that happens, you're going to see a supportive environment for listed companies and their ability to access capital.
Thank you, Neil. And I'd certainly, such an important issue, I'd like to ask any of our panelists if they have a perspective on Neil's comments there.
I mean, I'll certainly jump in. My view is that when you look at the US versus the UK, I think the US focus, certainly from a QA, if you look at QE as a proportion of GDP, it's been much higher proportion in the US. And I think that the US has targeted the market response probably more than the underlying economic response. Whereas I look at UK and Europe, there's been a lot of focus on, trying to avoid or defer unemployment. So I think that in the US has provided a lot of support for the market. In the UK, you're probably seeing less of that, but you would hope that because of what's happened, there'll be a longer term benefit from, the underlying economy essentially feeding back into the market rather than the market feeding into the economy through QE. The other thing I would say is, and it actually goes to Richard's point earlier, is I think that you look at the differences again between the UK and the US. We look at year-to-date performance. Large cap, even though small caps in the US did recover during Q2, large caps have still outperformed small caps massively in the US, and it's actually been concentrated amongst very few stocks. Whereas in the UK, small caps year-to-date have actually, if you look at AIM, have actually outperformed, and this is probably why Richard's relatively happy, have outperformed the large cap market. And I think there has been a real difference between the two markets. And again, it goes to this point as well, I would say, about the difference in the UK and the US and support for small caps. A lot of companies may sit in the UK and say, I think my valuation is relatively modest compared to what it would be. But I don't really think that there's necessarily a massive amount of support in the US for 100, 200, $300 million market cap companies to go over there and receive re-ratings. I just don't think that's probably the reality of the situation. And we've actually seen that during the crisis.
Thank you, Chris. And Neil, we're talking very much today about the UK markets, but certainly in the context of policymakers, the SEC put forward quite a controversial rule change for 13F filings, changing the minimum reporting thresholds from, I think it was around about $100 million to $3.5 billion. What impact do you think that's going to have on the small cap community? And what is your view and what should be done there?
So I think it's a broad theme that we've seen anyway, which is that companies, with all the regulatory change that's happened, with all of the sort of flow of capital into different, the institutional market is not the only market to raise money out of. There are vast pools of money available. They're just hidden effectively from issuers. And I think that this rule change is just another thing that obscures where those sources of capital are. So you're losing a signal in terms of the patterns of which funds are buying which stocks, how they're identifying with which types of strategies or types of sectors, and it means that companies are going to have to work harder effectively to get to know investors, their preferences, and how they get out there, reaching out to those investors that meet their needs.
So there we are. And I'm afraid that's all we've got time for. It just leaves me to thank all of our guests, Stephanie Baxter, Richard Penny, Chris Mayo, and Neil Shah. You've all given us lots to think about. We'll be back with the next installment of our Capital Chasm series focused on the US markets in a couple of weeks. Thank you.